All right, let's get to more on the massive sell-off that we are seeing in Credit Suisse. The stock hitting an all-time low today after the Swiss bank's largest investor, Saudi National Bank, said it would not raise its stake in the company. The drop in Credit Suisse is also putting pressure on the broader financial sector. European banks, large-cap U.S. banks, regionals, all taking a pretty significant hit today. We want to bring in Chris McGratty. He's the head of U.S. bank research at KBW. Chris, it's great to see you here. So just first, your assessment, your takeaway of the action that we're seeing in the market today and how that further complicates everything that we've been talking about over the last week when it comes to the regional plays.
Yeah, right. Thanks for having me on. Really, this started last week, right? We saw SVB come to the market and tell the market they wanted to raise capital for an issue with their balance sheet. They obviously did not raise the capital. That set off a string of events over the weekend where we've seen now two banks be seized by the FDIC, SVB and Signature Bank. And so we enter this weekend with confidence at real low levels. And over the last couple of days, you've seen the bond market really start to reflect, I think, your point about slowing economic expectations and rate policy.
Chris, Ines here. The measures that the Fed took, that the Treasury took, the FDIC to backstop the banks in the U.S., the regional banks, and give some confidence, really shore up confidence in the banking system. Yesterday, it looked like things were looking brighter when it comes to banking. But now, are these measures enough? Does more have to be done in order to shore up more confidence in the system?
Well, over the weekend they made a big move. They began to provide additional liquidity to the banks because the deposit situation at these institutions is becoming more uncertain. Deposits are running out, and so the banks need additional liquidity. They took that step. They also took an important step by saying the depositors of SVB and Signature, they will be made whole 100%, and that was a big concern going into the weekend. What they also said is they are comfortable zeroing out shareholders, given what's happened to these balance sheets. So this was the first step. The liquidity was the first step. My guess is there will be more. I think some people are asking, can the FDIC provide a blanket, explicit guarantee to guarantee all deposits? Now that requires an act of Congress, but that is something we are talking with our investors about in order to restore some of this confidence that's been lost.
Chris, the comments that we heard from the Saudi National Bank chairman, is that enough to explain the drop that we're seeing in Credit Suisse, really the panic that we're seeing across the board when it comes to financials today?
So speaking maybe more high level, confidence levels is really important in banking. And so capital levels coming into this for the broader financial system were very strong. We made a lot of steps after the global financial crisis to raise capital, to raise regulation. And we've seen that mostly play out. What we're dealing with today is not a credit concern. We are dealing with liquidity. And the view on liquidity is it can strike very quickly, which is what we're learning. And to restore confidence, you need policymakers to make some statements to get investors more comfortable.
But break it down for us as far as what we saw with SVB and now what we're seeing today. You're talking about liquidity, but with the markets, I mean, it seems like there is something breaking in the markets. It is in the banking sector. This isn't like 2008. It's very different. And you're talking about different types of banks. I mean, Credit Suisse is much bigger than SVB. Break it down for us briefly.
Sure. It feels a lot like 2008. And I was in this seat in 2008. And the feeling I've had over the past 4 or 5 days feels very similar. The difference between 2008 and today, 2008 was about credit quality, bad loans, and excess leverage. Today, the credit quality of the institutions in the financial markets is great. Capital levels are strong. What you're dealing with is a liquidity crisis. So the Fed has injected over the past couple of years after COVID a tremendous amount of liquidity into the financial system. And as the economy healed, that liquidity is being withdrawn. And so what you saw last year, you saw interest rates rise by a significant amount and also in a record short period of time. So this liquidity is being pulled out of the market all at once, and that's creating this volatility.
So Chris, given all that, what banks do you like in this environment?
Sure. We put out a note as a firm on Sunday really saying you got to be careful. You can pick your spots, but just as a background, we are neutral on U.S. banks. We moved to a neutral rate in December. And really, the call was that we were at peak earnings. The industry was doing very well, but the earnings growth was slowing. And so what we said to our clients over the weekend is, hey, the environment's going to be volatile. You can buy safe haven, quality companies at inexpensive valuations. We like regional banks such as Old National Bank, Webster Bank, East West, Wintrust. These are quality banks that are not caught up in a lot of this uncertain idiosyncratic risk. At the other end of the spectrum, some of the hardest hit names we think has been unfairly punished. We like a company, Western Alliance. This is a very high quality, top tier profitability, great balance sheet, who's caught up in a lot of the volatility. So the stock's suffered tremendously, but it's starting to claw back. And we think the risk reward for this one is particularly attractive.